Hi everyone, welcome back to your favorite finance podcast, The Lens, with Larry McDonough and Craig Shapiro. This week we bring you the greatest insights from our Bloomberg live chat. So let me explain you guys a little bit. In 2010, Larry sat down with our analysts and said, "We have to do an ideas dinner every day, but it's kind of expensive." So we created this platform. We have this institutional live chat on Bloomberg. Right now, we have more than 600 investors all around the world, and you can be a part of it too. If you're interested, do not hesitate to reach out and go to info@thevirtualreward.com. Many thanks. Go ahead, guys.
Thanks, Valentina. And the nice thing is Craig's running the Discord room. If you're coming off a plane out of a long meeting, hop in Discord. It's a really great institutional platform, family offices, wealth managers, and we're really working through what's happening during the day, the week, and the month in markets. Craig, so a little bit this week where the conversation in the chat, the biggest trend shift over the last 3 weeks is the move toward hard assets in this stagflationary type world, financial repression, where it's pretty clear today what's happening. Interest on the debt's 1.1 trillion bucks, right? They got to massage interest rates below the rate of inflation with a $37 trillion debt hole, and Powell just basically rolled over it. And all that means in English is like, okay, you're seeing a rotation. The leadership of the market is changing slightly. The Mag 7, essentially the Mag 7 ETF, as of this morning, was up, like barely up since December, barely up. But you're seeing a move not just into gold miners, a lot of companies that own assets. There's a shift toward that more stagflationary portfolio. Craig, is that what are you hearing this week in terms of the conversation with the institutions?
Yeah, no, I agree with that wholeheartedly. Up until 10 a.m. this morning, that we were seeing folks shift out of big tech, and they were making two shifts, right? Some folks were shifting into that pro-cyclical, small caps, weak dollar plays, inflationary plays, because they believed that the economy was fine and likely to reaccelerate with support of a Fed cut. And then there was another shift for some others who were shifting into a more defensive posture, right? We saw some outperformance in staples and in utilities and in healthcare. But still, the broad thesis was kind of get out of some of the winners in some of the Mag 7 and the AI related names of big tech names, as the Fed was likely to start its easing process. Now, over the last couple of days, we did start to see a little bit of a shift after some hawkish Fed minutes and after some hawkish Fed members like Hammack and Schmid came out and kind of suggested, like, September is not a done deal yet with respect to the rate cuts. We're still a little bit concerned that inflation is moving higher, certainly sticky. And maybe the labor market, even though it's slowing, it's slowing. It's a slowing demand and slowing supply situation. So, not really something to be overly concerned about. And so the market began to shift a little bit back. And we took the rate cut odds from over 100% in the middle of last week to about 70% this morning. Into 10 a.m. and Powell. We can get into what he said,
but big picture, Craig, we're going to cut rates with PPI, two standard deviations greater than the norm. Is that right? And ISM going through the roof, prices paid, Philly Fed.
Yeah, look, I mean,
how do you justify that? How do you?
Yeah, look, I mean, the Fed is clearly showing its asymmetric bias here. It favors the employment mandate over the inflation mandate. And so to the extent that the labor market is showing decelerating momentum.
But Craig, didn't the minutes yesterday said the opposite, right?
Yeah, look, the minutes, weird. And the minutes said
the Fed minutes. And explain what the Fed minutes are.
So the Fed minutes come out 3 weeks after the Fed meeting. So they were, look, this is before the meeting takes place, before the very sizable disappointment on the July non-farm payrolls employment print, which happened on August 1st, right? So the minutes the Fed meeting happens before that. So many members view upside risks to inflation, and it seemed like the minutes were reasonably hawkish, or the Fed meeting at the time was a reasonably hawkish outlook, which is not necessarily going to be cutting rates in September. But then the bad Payroll print comes out at the beginning of August with massively revised lower revisions for the prior months. And now you're seeing more Fed members come out and being concerned about the deterioration in the labor market. That being said, we're still at 4.2% unemployment, right? And
But look at super core, Craig. We're bouncing off of the 2012 to 2017 highs. We're going the other way.
Right. So the Fed says, the distance between where we are and the mandate will determine what they should be focused on. And so in my view, when you're basically saying 4.2% is very close to maximum employment, and 2% is where you're targeting inflation. If we're running inflation at 3%, that's further away from 2% than wherever the labor market is from max employment. Yet the Fed, and confirmed by Powell this morning, wants to favor the slowdown in the labor market over bringing inflation back down to 2%.
Right.
I think people didn't think that was going to happen, and yet it did happen. And he has now set the stage for the beginning of a rate cutting cycle in September, unless we got heroic positive revisions on non-farm payrolls and a massive inflation print. But it seems like we're starting the rate cutting cycle, and bringing down inflation back down to 2% just seems like not something they're overly concerned about or particularly interested in getting to anytime soon.
Right. And so one of the things we talk about in How to Listen When Markets Speak, top 10 in Amazon. But the whole point is, if they change the inflation target from 2 to 3% very slowly, and that's what's happening, they can't do it fast. They're like the pilot on the airplane with the engine in trouble. They can't tell. They want the fannies in the seats. They have to do it very slowly. But if you move from a disinflation certainty dynamic, which we had for the last 15, 20 years, to a more stagflationary certain world, look how the industrials are starting to outperform the S&P. Industrials have been strong this year. Global Value, EWU type names, companies that own assets. They've been outperforming. The market's broadening out, and those sectors are outperforming as we move more toward a stagflationary world. That's what the chart says here.
Yeah, what you're getting from some of those companies, you're getting the expectation that prices are going to go up, whether it's tariff pass through or just tight supply demand. And then with the labor market slowing down, lack of wage inflation and artificial intelligence maybe reducing the need to hire more workers. And so you're seeing margin expansion expectations coming into large parts of value, large parts of industrials, and large parts of companies that have been left behind, let's say, by the AI boom and tech outperformance over the last several years. And that's filtered down as well into some of the smaller companies that would also benefit from a rate cutting cycle, right? The cost of capital moves lower. Some of the smaller companies, highly levered companies, are benefiting as well. But the question from here is the Fed really cutting into an economy that's getting better and inflationary, or is it cutting into an economy that's getting worse and inflationary?
Well,
I think that is the big question.
So another thing people are talking about this week, several clients that run large portfolios in Europe and London, the United States, are making the point margins are in trouble because if you have that ISM prices paid, if inflation and tariff inflation is still coming in, that's what Walmart said yesterday. If it's coming in, it's either the consumers are going to pay or margins are going to pay, and so it's almost, one of the clients made a great point. It's like if you told the market in January that tariffs were going to normalize at 10 to 15%, the market would not like that. So what's happened is now that tariffs are here, it's the summer, people are kind of not really thinking about markets the way and the impact. But now if tariffs are really going to normalize at 10 to 15, and we're slowly coming to that awareness, that's either margin pressure or more pressure on prices.
No, for sure. I mean, I think, look, the other thing that we have going on here in markets over the summer has been, massive volatility suppression and releveraging of portfolios and systematic releveraging from vol control funds and CTAs and other, I'd say, non-fundamental players. And so the market's been very sanguine on this view. So all these big picture risks that have been out there about an economy that's slowing, about margin degradation from tariffs, about consumer companies not being able to pass things through, or about low-end consumer wallet share strains. We're looking through it, right? The market just broadly looking through it because some of these other factors. But as we transition, and put summer behind us and get back after Labor Day, we have to deal with this reality of an economy that is slowing, a Fed that's going to start a rate cutting cycle, but it may not be an aggressive cutting cycle. There's a couple of Fed members who think we're basically right at neutral right now. And even Powell in the speech this morning are likely, or he said as such, he basically said it's likely that the neutral rate is higher than it was maybe prior to the pandemic. So the pace or the magnitude of the rate cutting cycle this time around is probably not going to be as big. Going back to 0% rates is probably not going to happen. So what's going to be the impact of that rate cutting cycle? Is it going to arrest the economic decline? I think that's, coming in the next few weeks here. I think we'll be dealing with that. The other thing we're going to be dealing with is as the dollar weakens, which we're seeing today, as commodity prices move higher and inflation expectations start to move higher, what's the long end of the bond market going to do? Global sovereign yields, we've been noticing it. I'm talking about it for the last couple of weeks in Japan, in the UK, in Germany, all moving higher. And if the Fed now has an inflation credibility issue, the long end here is likely to sell off too. And what does that mean? So I think that, we're going to be coming into some pretty interesting potential pivot points here as we exit.
Well, that's the thing, Craig. The moment they dove up a little bit, the dollar gets hammered, commodities rip, metals rip. So it's like it immediately flushes right into stagflation again.
Stagflation,
It's just
exactly.
like that. Look at that dollar move. And look at that dollar. The dollar keeps failing at the 50. That's a very, you can see that MACD roll in the bottom there. But 50-day moving average over and over again, failing. And each one, that's either the Fed shifting more dovish, so the U.S. economy slowing down a little bit. Now, gold miners, Adrian Dave made a point yesterday. It's fascinating. Gold miners are up 60% year to date, crushing Mag 7. Junior miners are up even more. It's around 70%. So companies that own assets in the ground dramatically outperforming in that stagflationary world. But lo and behold, what was the stat yesterday, Craig? $2 billion has left the GDX this year. In other words, so he's talking about outflow. So even though, so the index is up 70%, but net, there's no retail buy-in to gold miners. And that means they have a lot more to go. As you can see, the GDX dramatically outperforming the Qs over 1 year, 2 year, 3 year period. This one's, again, that's hard assets versus financial assets. We had 17 trade alerts over the last, 2-3 years, long GDX, GDXJ, long the silver names, SIL. So we've been very bullish on a hard asset portfolio. Don't forget that. We've been the most bullish we've ever been and all these trade alerts real time stamped.
And look, really what you have is you have an administration that's favoring a weak dollar policy, right? It wants a weaker dollar as it tries to restore manufacturing, bring the supply chain back to America, restore jobs, rebuild semiconductors, pharmaceutical plants, a variety of other things, mission critical things that America needs. So we know the administration wants a weaker dollar. The Fed, is the offset to that. And to the extent that it keeps rates higher, it supports the dollar. But now if you have a Fed, as Powell is suggesting today, that's going to be less desirous of bringing inflation back down to target and more supportive of making sure the labor market doesn't fall out of bed, then you have a Fed that is supporting a weak dollar too. Both those moving together today. I mean, dollar euro is 1%, dollar yen is 1% plus. I mean, gold's moved 1%, Bitcoin's moved 3.5%. So all the weak dollar benefit.
And look at these. Look at the XME versus the Qs, destroying the Qs. Metals destroying. We're going back 5, 6, 7, 8 years now, destroying, and that feeds into what you're saying.
And look, I think you add to that the AI capex build out, the reconstruction that needs to take place in the Ukraine and other areas, and so commodity intensive. China, is likely to do more stimulus. So the commodity intensity of the next few years with limited supply growth is coming, and then you add to that this weak dollar posture. It's been a pretty supportive backdrop for the hard asset trade, and is likely to continue here throughout the rest of this year and into 2026.
And if you go back, Jose, go back to the first slide around buybacks. So this is fascinating. So 2021, 22 buybacks were on the lows compared to now. But one of the clients made a point in the chat around uh, the buybacks are in the 94th percentile. In other words, we're at the highest level in the last decade. We're up there in the 90. We're probably right near the highs in terms of buybacks. But the insider trading or selling is at the 94th percentile. So these guys are like, they're selling their personal equities at the fastest pace in a while, but they're also announcing buyback plans at the fastest pace in a while.
No, and look, the other thing we have is a big increase in convertible bond selling. We've had a restart of the equity market recently, so there's supply now of equity that is balancing this buyback flow. And we know that the buybacks run until, let's say, the middle of September, and then there'll be a blackout period that starts for buybacks. And then on the systematic side, the CTA flows and vol control flows and risk parity flows, those folks have been buying hand over fist as correlations have fallen, as realized volatility has fallen, and as just broad-based volatility has fallen over the last 3 months. And so those entities are very much long again here. So look, where is the incremental support and buying going to come from? Here over the course of the next few months before we get into that seasonal year-end rally that everybody, I guess, is waiting for. So I think for the next couple months here, need to understand, is the Fed cutting into a weakening economy or a reaccelerating one? And what is the bond market? How's the bond market globally going to react to those inflationary pressures?
Let's talk about the bond market. So when they originally started the cutting cycle, bond yields started to come down, then ripped high, right? Today, I find it interesting that bond yields are down a lot today. And so bonds are telling you the economy is slowing down, right? Like, why are bond yields, if the economy is reaccelerating, that's the street's been telling us all the last 2 weeks, the economy is reaccelerating. So, but bond yields are coming down. And if the economy is reaccelerating, why is the Fed cutting rates?
The narratives are inconsistent, right? I think you don't, between FX, commodities, the bond market, the curve, and equities, there isn't a unilateral consistent message here, which I think is because we don't, the data is mixed, right? For every good data point we get about PMIs reaccelerating, we get bad data points from the low-end consumer or from Walmart, from housing. And so I think we still have this bifurcated economy. Some things are doing incredibly well. Other parts of the economy are doing incredibly poorly. And so we kind of keep going back and forth here. But the Fed is going to respond, or looks like they're going to respond to this slowing in the labor market. And they're going to do so ahead of really showing a sustainable path back down to 2% inflation. And while Powell reiterated that 2% is the target today, their actions suggest that that it's maybe not. So, we have to watch what they do, not necessarily what they say. And, look, if they're going to, like you said, Larry, if they're going to be cutting with core CPI going to 3% and above, prices paid indices basically making multi-year highs, and every company talking about tariff pass-throughs, we're gonna see higher inflation, and the dollar continuing to be weak. We're going to see higher inflation prints between now and the end of the year. Certainly that has implications for how people should be shifting their portfolios and allocating capital.
Right. Pick this baby up. The last thing I want to say, Craig, is that around the bottom part of the economy, and I think this is one of the things that has the Fed nervous, is that we saw the Sallie Mae number last week. We talked about it on the show, but the tertiary financials, the Navis, anybody that's lending capital for student loans or credit acceptance, CACC, a lot of the subprime stuff is to continue to roll over. And the theory, I guess what I'm hearing from clients is that forbearance period, where all forbearance means is like when you have student loan and there's a period where you don't have to pay it back, or where you push out the payment cycle. And there was a forbearance with the LA fires, there was forbearance with student loans, and now all that, according to some clients in the chat, that turning bearish on the financials, if those periods have come off, and now it's been a long time, but right now, as of this quarter, all that forbearance is rolling off. In other words, so if you have those student loans, your payments are going to have to start picking up again, whereas you had a period where you didn't have to make the payments. And so that's interesting. That's something that that's why you want to watch some of the subprime lenders, because what we're being told is that's going to kick off consumer default cycle, because you have, maybe it's 75 million Americans that all of a sudden were given a forbearance period. That forbearance is coming off. All of a sudden, you've got extra payments. You've got a much more heavy, payment cycle, or payments monthly toward your debts than you had before, and that's going to trickle into other parts of the market, especially the tertiary financials. But I think that's a great recap for the week, Craig. Anything else that you think is important?
No, look, I mean, next week we have NVIDIA, right, which is going to be, highly anticipated, highly scrutinized about, where are we in the AI capex cycle and profitability?
Craig, how about power bottlenecks? Doesn't Jensen have to come clean? How can you have that kind of growth expectation with power bottlenecks are right around the corner? You got Google doing a panic move into buying, part of Wolf, which is a Bitcoin. It's a Bitcoin power
Mining.
Bitcoin miner, but it's a real power play. So you have all these hyperscalers that are panicking around power, and if there's it's the thing that I keep hearing, Craig, around NVIDIA is the street's gone all in on capex. Everybody knows the numbers, 2 trillion. There's a number every day out there, but nobody's looking at these bottlenecks for power and the impact on the potential.
Yeah, look, I think that people just assume that all these companies are cash-rich companies, which they are, and that they will spend as much money as necessary in order to bring on power and utilities, faster than not. So they're going to be paying up, which is going to destroy, the unit economics of all their capex investments. But yeah, you're right. Look, the truth is, there's still a short. They're not going to be able to do it as fast. They're not going to be able to spend the capex as fast as they think, because the bottlenecks here. And even with the Trump administration is helping on the regulatory side and the environmental side by saying you could do whatever you want, whenever you want, without any permits, which is basically what the EPA now is doing. It still takes time, right? And there's still lags in order to get mission critical equipment and people. So there does seem to be a disconnect here between what the hyperscalers want to spend and actually the capacity of the current economy to actually deliver that spending. And if they're going to do it, it's going to come in an inflationary way, right? The PJM, which is the Mid-Atlantic Power Authority, basically talked about wholesale power prices up 20% next year versus this year, because the data centers demand on power. So low-end consumers are going to continue to see a strained wallet share, right? Utility costs going up, high single digits, insurance costs going up, and now you mentioned just these forbearance periods ending, and so the necessity with which they have to start paying back debt is going to grow. Their ability to spend discretionary in the economy is going to continue to be reduced. And if the labor market is slowing and people's angst about the future labor market continues to grow because of AI, we are setting up for a struggle here for the low-end consumer. And that'll also have implications for how people should be allocating capital and thinking about investing portfolios to the end of the year and beyond. So markets are making highs. It's the summer, but there's a lot to be digested now that the Fed is transitioning into a cutting cycle, into a slowing economy that is still showing strong inflationary momentum, and so we got to kind of have to go through that.
Yeah, NUKZ names destroying the NASDAQ this year. It's one of our core holdings. A lot of the holdings in the NUKZ, we've been long for almost 2 years now. And, the SMR stuff, the small modular reactors, it's going to take years to get that stuff to market, really effectively producing power for a hyperscaler on site. Even though the Trump team is doing a lot around regulation and deregulation, it's still the technology's not quite ready for prime time on SMRs. And so that's where there's that gap between the capex and then the bottlenecks and then the reality of the power. But thanks, Craig. Have a great weekend. Valentin, Jose, everybody, the entire team in New York, thanks very much, and we'll
Great.
catch you
Take care.
next
All right,
week.
thanks.
Okay.
Thank you, Craig. Thank you, Larry. And thank you, everybody, for watching. Remember, as the guys mentioned, we run a Discord channel. We also run the Bloomberg channel that I spoke about earlier. We have this new report called the Washington Pressure Point, and absolutely every client loves it. And I know you're going to love it too. If you're interested in having our latest copy of Washington Pressure Point's Turning Point, or if you want to take a quick look at our chat, either Discord or Bloomberg, you can reach us at info@thereceptioncore.com. Also, remember, you guys, we're in the top 10 again this week, thanks to you, and we would like to keep it that way. So if you haven't have your copy of How to Listen When Markets Speak, get yours now on the link below. Thank you very much, guys, and we'll see you next week.